I think 91 was a major watershed year for India's economy. Those reforms basically allowed a lot of foreign capital to come in, foreign investors to come in. That changed the governance, that changed the way Indian corporates think and behave. We are a democratic system where people can make money and take it out. From long term, that makes sense because people know that this is a country where if we make profit, then we can take it out. So what has happened in FDI that that original investment, when they're exiting, and they're exiting at profit, so then they're taking away a lot more than what they invested. But if you have to have a capital formation, then equity is the foundation on which you can raise debt. Only 30% of India's GDP is contributed by MSME, whereas in South Korea, China has almost around 60%. Our business has been around for us. We didn't get into real estate, we didn't get into power. I mean, there were temptations. We didn't get into solar, which was so attractive at some point in time. So the best advice, although it's boring, is not exciting, is that you do a systematic investment or systematic savings. So just like, we had a piggy bank when we were a child. So every month you save and you invest. Don't worry about the market. You cannot time the market. What matters is the time that you are invested in the market. So what does that mean? Is that at any point in time you take a snapshot. Oh my God, there's so many problems. This is wrong, this is wrong. But you say 5 years, 10 years, 15 years, is compounding. Things are getting better.
We are joined today with another very interesting guest. Mr. Nirmal Jain is the chairman of India-IIFL Finances Limited, IIFL it is called. And there are several companies that have come out of it. So we will talk to him at length. He's a very interesting person, born and brought up in Bombay. Then he went and became a chartered accountant. Then he became a cost accountant. Then he did an MBA from IIM Ahmedabad. And then he joined Hindustan Levers of all things and became a marketing person from the year 89 to 1995. That's 6 years. After that, he just gave it all up and started off a finance business, which is a business of serious size now. So welcome, Mr. Jain.
Thank you, Mr. Rizvi. Thank you, sir.
Thank you. Very kind of you to come. So we'll go straight into the economics and the policy part first. So India has seen 30 plus years of liberalization, financial liberalization. And in all these years, what are the big 2 or 3 changes that you see that have happened in the architecture?
I think major changes have happened in last 10, 12 years, and more so they accelerated in last 5 years. And one of the most significant thing where India is way ahead of even developed countries is our digital public infrastructure. So if you notice our payment, even if you go for a coconut water on the beach, you will have the QR code stuck on one of the coconuts. You can just scan and pay. You can pay as much as 50 cents or 30 cents with no transaction cost as such, which won't happen even in countries like US or many other developed countries. So besides this UPI, also we have account aggregator, we have Aadhaar, which is unique identity. So all these digital payment and the trail of it is allowing India to get financial inclusion at scale. Also, the Jan Dhan scheme, which basically opened several million, tens of millions of bank accounts, and practically included every Indian in the villages or at the bottom of the pyramid in the banking system, so that the direct benefit transfer can happen. There are very few leakages, and along with this. Now, the lending can be data based or data driven rather than relationship based, where most of the smaller customers or smaller borrowers or smaller businesses were getting excluded. Now, the process is started that they can get included because the digital infrastructure allows their credit assessment to be done
So,
at negligible cost.
so before the digital infrastructure, say that's last 7, 10 years, prior to that, in those 20 years, what are the big changes that you saw in the financial architecture?
You're talking about, say, 10 years ago.
91 to
Yeah.
2004,
So I think
5.
91 was a major watershed year for India's economy. Those reforms basically allowed a lot of foreign capital to come in, foreign investors to come in. That changed the governance, that changed the way Indian corporates think and behave on one hand. The much reduced customs duties, import duties also opened India's market. And actually, that laid the foundation for the explosive growth in India's IT in the late 90s. And I think that was a very significant booster for Indian economy because India, otherwise structurally, is a current account deficit country. And as you know that we have dependence to import oil, and that basically takes away a lot of our foreign exchange. And IT sector could grow very rapidly.
Okay.
So I think there were a number of things that happened in telecommunication. The mobile revolution was a big revolution for India's economy and financial sector, which happened in early 2000, the first decade of this century. So I think from the reforms in 91, which opened the economy, and that accelerated the growth path, from a Hindu
Yes.
growth rate to which was 2-3% to say 5-6-7%. I'm talking about long-term moving average or a structural growth rate in real terms. And that was aided by internet in the late 90s, followed by mobile. And the reforms from 91, they continued, and actually that helped the Indian economy a lot.
Okay, and then the digital got added and it's taken us to this high growth path
And
in which,
then the financial inclusion, Jan Dhan, all those things
yeah.
further accelerated.
So this high growth path that India is on amongst all other countries, we are like 6-7% regard in 3 years moving average, we'll always be at 6-7%. But however, the growth of money supply and the general growth or nominal growth, these are slightly coming down. So how do you see this playing out in the next decade?
So there are two things. One is 6-7% we are playing much below our capacity. Given India's entrepreneurial, the spirit and the enterprise that we have, given the demographic of young people that we have potential to grow at 10% also. But many things have to change, and actually they are changing. But in a democracy, things happen at its own pace. As far as nominal growth is concerned, if the inflation is low, your nominal growth will be lower. So say 6% real growth and 4% inflation, maybe 10%. If the inflation were higher, nominal growth would have been higher. While nominal growth optically looks like money or in your bank growing faster, or your salaries and income are growing faster, but that doesn't really improve the welfare, because the things that you buy with money are also getting more expensive. And inflation hits the poor people more, because they end up almost investing, spending most of their savings or most of their earnings. Therefore, we shouldn't worry too much about the optical growth rate. What it means is that the corporate earnings growth in nominal terms, because they're always nominal terms when we report in our annual report or what we see in our bank, they may look lower, but the standard of living is improving because inflation is not there, or it's very low now. 3-4% is one of the lowest that India has seen over long term. So in a way, that's healthy.
Okay. So, how do you see this problem that has recently come up, that of the declining rupee, and stories that keep coming about how net FDI is very low? So, how do you see that playing out? What should be done?
India is vulnerable to oil prices, and structurally and current account deficit we have, because our export growth over last so many decades has been a bit erratic. Also, the world has changed in terms of the way world trade is taking place. And therefore, India has dependence on capital inflows, which can happen by way of NRI remittances, by way of foreign debt, by way of foreign equity. And the foreign investors, portfolio investors, as an FDI, they have been actually in last 1 year or so, they've been selling and they've been actually taking the capital out. We are a democratic system where people can make money and take it out. From long term, that makes sense, because people know that this is a country where if we make profit, then we can take it out. So what has happened in FDI, that that original investment, when they're exiting, and they're exiting at profit, so then they're taking away a lot more than what they invested. Fair point, because businesses are done well and they are eligible for reward, and they're taking it. And from long term, that's a very good message. But India has to attract capital in a sustainable way. For instance, long-term capital gains tax. Now, most other competing countries, whether Singapore, Taiwan, or Thailand, or Malaysia, to the best of my knowledge, they don't have this tax, long-term capital gain tax. Many times, government and policymakers are driven by comparison between what are local retail investors paying and what foreign investors are paying. And then they say, okay, we are local investors paying say 10%, 20%, 30% tax. Why should foreign investors not pay? But what they should realize that when this foreign capital, they are not competing with local savings. We are competing with the other economies that can attract those capital. And that capital basically, paradoxically, will be good for the local investors, because that will drive their savings and earnings.
Okay.
Because that's the capital. Formation in the country will accelerate, which will drive new jobs, more income, and therefore, so something you and I, on a superficial, we may not like this, that I pay so much of taxes, foreigners don't pay taxes. But what I don't realize, that foreigners are earning somewhere else, they are not earning here. And That capital can go to Malaysia, that capital can go to Philippines, that capital can go to Vietnam, that capital can go come to India. If that capital comes here, will be used to build factories, roads, airports, whatever, and that will help you and me because that will improve our earnings.
So these recent changes that were made to attract FDI, do you think they will work?
I think we need to do a lot more. We need to make our equity attractive because what people have to understand, and many policymakers and politicians, make mistake that they think that equity is speculative. Sometimes you hear that most of the people make losses in futures and options, so we should shut it down. But if you have to have a capital formation, then equity is the foundation on which you can raise debt. You want to set up a new business and you need say 5 billion. So first you get 2-3 billion equity, otherwise who's going to give you debt?
Excellent.
Okay.
Yeah.
Now equity is the risk capital. The risk capital will always have profits and losses. So you can shut down and say I don't want risk. Then obviously there will be no growth, no capital.
Excellent.
We are capital deficient country. So what we need to understand is that we need to attract equity, like China did in 80s, 90s in a massive way, and so much so that the entire growth actually was driven by foreign capital, and now their domestic savings and the surplus that they generate on current account is massive.
All based on the original
Yeah,
foreign capital that they
but
got.
when they attracted capital, they made it very easy for them, much
Yes.
more easier. So for them, giving land, license, anything is very easy because
Yeah.
it's not a democratic country. We have our constraints and we should appreciate, but in a way, for on a larger welfare and well-being and the freedom, of course, we cherish that, and there's no need to compromise. But even within that democratic structure, we can attract capital.
Yes.
We can make things easier.
That's a good point. So,
And I think policymakers, even for foreign debt for corporate, there's a withholding tax. So many of these, the revenue considerations, one must realize that the revenue is much more, vis-a-vis if the rupee is depreciating by 10%
Yeah.
in a short time. You really can't talk foreigners into it. They are all businessmen. They
They're
have
all
to say that,
looking for
okay, where
profit.
things are attractive.
looking for profit. That's
They're
what
looking for
attract-
profit, they're looking for ease, and they're looking for low taxes. And if you, now, because we have to catch up with many of these, like countries like South Korea, China, they're way ahead in terms of the economic development. If we have to catch up, then we have to make it more attractive. We have to really roll out red carpet.
Exactly. Comparative advantage should be ours.
Because the more foreign capital comes in, the faster it will be the growth, the better it will be for the common man and the bottom of the pyramid and the poor people of this country.
Okay, so coming to credit, which is a major part of the business that you built. So in credit, we still see MSMEs struggling for credit. How do you see that whole story?
If you see last 75 years, every finance minister in the budget speech or somewhere would have spoken about MSME being priority sector. We want to, and India is unique because MSME loans are considered priority and banks are obligated to do 40% of their net term deposit lending to a priority sector, which includes MSME. And yet, only 30% of India's GDP is contributed by MSME, whereas in South Korea, China is almost around 60%. For us, supposing we want to go to that level, it's a long, long way. It's very difficult also. You can imagine that out of 4 trillion economy, if the MSME is contributing 1.2 and is going to grow to 5, 6, can they contribute 50, 60%? It's a long way. Very difficult to imagine. What does it mean? It means that if MSME grows faster, then the economic growth, welfare and wealth is well distributed.
Okay, yeah.
We don't want that to be concentrated in few
Big company.
large corporates or large big houses. Okay, nobody wants that, but we have not been able to achieve it. Primary reason for a long time has been that they are unorganized, so they are not united. They don't have a voice. The 85 million MSME enterprises, small enterprises in this country. I think this is Niti Aayog estimate, give and take 5-10%. So 85 million small businesses, massive number. That's much bigger than even population of many countries. Out of the 85 million, maybe my guess is 2-3 million, not more than 5 million, get bank credit. And bank can say, okay, we are lending so much to MSME and we are done. But the long tail 80 million have no access to credit, no formal access to credit. Now, what is happening is that there is a risk, there's a credit risk, which is a real credit risk. The government schemes of insurance against those credit losses, they don't have a wide reach, they are very underfunded and they are relatively weak. If we really want to drive MSME growth, the small business, what do he need? First of all, he'll need capital. He'll need to borrow money. I mean, I got a small shop. Can I borrow 50,000 rupees, 1 lakh rupees and stock it up more so that I can sell more? That is how. And I think if we can grow MSME, then the bottom of the pyramid will grow. They'll produce more. And the same set of people, which is a very large number in this country, will consume more. And that is how the economic growth will
Yeah.
accelerate.
Okay. So
But so whether they are land, labor, the taxes, the licenses, availability of infrastructure, availability of electricity, power, water, there are lots of things that have to be done.
So in the same vein, unlocking capital, more capital for the country. Within this country, we've got so much of gold. So gold loans is something that a lot of companies work on, including yours. So gold loans, they become somewhat mainstream of credit. So if gold prices fall, then what happens? Who takes the risk?
So, the gold ownership of households in this country is like an emotional ownership. The gold prices have gone up. It's not that they've really become, there's income flow. I don't think most people will trade in gold because they're jewelry against which the loan is given. So, if there is a price fall, typically most of the lenders lend up to 75% of LTV, so they have 33% cushion. Also, they value gold on the purity basis, but the actual value or actual cost to the household that is pledging the gold is a lot more. Because suppose there's a jewelry, I might have paid a lot more than the gold price because there's a design and everything, You have a necklace or a bangle or a Mangal Sutra. The gold content may be 70-80% of it, but I paid 100 and I got valued 70, and out of that also 75% is what I get loan. So typically, the cushion is almost 2 times, practically from the borrower's point of view. So borrowers won't like to lose the jewelry, mostly. And in a way, it's good. See, today gold loan is growing very rapidly. It's become very large asset class because unsecured lending has become difficult. In a way, it's good because when people borrow against gold, they are more disciplined. But when they say, take credit, wherever you pop up on the internet, e-commerce, they'll say, okay, I'm giving you credit, I'm giving you EMI. That is risky.
Yes.
Because many times people who are not so savvy financially, they end up borrowing when they don't want to. They end up clicking the EMI when they don't want to, and they pay interest. But if you take your gold jewelry out of your locker, vault, or whatever closet and give it to somebody else, it's a lot of emotional
Excellent
challenge.
point, yeah.
So then they won't do it in a careless manner or a reckless manner. So that is where, and people are talking about over leveraging against gold. What they miss out is there are always two sides of a coin. So if you take millions of customers, there are few may over leverage because money is available easily. But there are a lot more who have improved their living standards by borrowing. That is what is missed out.
Okay. So on similar vein again, the microfinance, how's that situation playing out
So
in
it's
the
very
country?
interesting actually. So in microfinance, what happened? Suddenly 2 years ago, there were strong guardrails, and there was a fear that some of the customers are getting over leveraged, and some of them have committed suicide, which is a very emotional view, a point actually. But many times people should look at it dispassionately, the economic angle and emotional angle both. So I'll give you an analogy now. In road accident, there are more than 300 or 400 people die every day. Nobody even talks or thinks about whether we should have road transport or not. Because we know that road transport economic value is more than 100,000 lives or 150,000 lives in a year. Am I right or not? Of course, we want to reduce the accident, improve the safety, but then nobody will say that you shut down road transport.
Yeah.
You can't. Okay. So there are millions of customers. If you really go and do a survey, then there are millions of them who have much better life because they got microfinance. Okay?
So doesn't mean if there is a
Because they
problem
could
in
earn
some-
more.
Yeah.
Now, there are stray cases of over leveraging and suicide, but because of that, you clamp down on the entire industry. Then what has happened is that the number of borrowers and the loan in this industry has fallen significantly in last 2 years instead of going up. Effectively, so many people have got financially excluded, like millions of them. There are so many of them who will be 10 years later, 5 years later, deprived of much better living standard, or sometimes medical care for their own families, or better education for their children, and therefore the living standard of next generation.
What you're saying is that basically a balance is needed
But is required
between too hard and too
yeah,
soft.
one should assess the both sides. What is the positive and negative, and the scale at which it is happening, and then take a call. That is what I'm sure that
Exactly. That's what the regulators do all the time.
government policy
At
makers
times
do.
it becomes too tight, then they loosen it because of interaction with
They're
people like
hypersensitive
yourselves.
about the risk and the negative fallout, and inadvertently,
Yeah.
they may miss out on the positive side of the
Yeah.
the so much of better economic well-being of and
Yeah,
somebody can do a
that's
survey to discover
very,
this.
very valid. So we now come to your businesses as
Yeah.
IIFL started as just IIFL, and you created IIFL. Then you basically built that whole company. Then you demerged those businesses. Then you listed them. You sold some of them. So can you take us through that story and what is the reasons why you did all this? The selling part.
So when I started this company more than 31 years ago now, so I realized that my core is financial services. Because being a chartered accountant, cost accountant, MBA, what I understand and what I'm really good at maybe is the financial world.
That you always
And
were.
that's what I was passionate about.
Yeah.
So in all these years, we have remained focused on financial services. Our business has been around finance. We didn't get into real estate. We didn't get into power. I mean, there were temptations. We didn't get into solar, which was so attractive at some point in time, or any renewable energy, anything for the matter. Within financial services, we have added many businesses. So we started with research on financial sector, then equities trading, then institutional equities, then investment banking, wealth management, asset management, lending, and retail lending, consumer finance, and all those. So all our finance services. Now within that, we keep learning and you have to correct your mistakes. So there are certain things which are not, your DNA, or maybe you took a call based on certain assumptions which did not work out. So for instance, we expanded into. So first we started with internet trading, then we got into wealth management. We expanded into foreign countries. Like we were the first broker to get into Sri Lanka, first foreign broker to get into Sri Lanka, and we were the first foreign broker to get out of Sri Lanka because we realized the market is too small. We got in because we thought the war is over and there'll be peace and there'll be significant growth. But we realized there's really tiny market. Then we got to Singapore also. We got a license, and then also we got out of that in 2010-11 because we realized that the cost of compliance in the foreign in a country like that compared to the business potential is really not what we thought.
Okay.
Then in lending we realized that commercial vehicle at subscale we are not able to do the way the large players are doing it, so we sold that business. But primarily our core remained the same. I mean there are
Financial
certain
services.
financials,
Yeah.
and we explored the world outside and we realized that India is where is the best country to do business and to do something good even for the customers as well as for yourself.
So how many of your subsidiaries are listed now?
No, they are not subsidiaries. They become independent companies. So
They're
when we
independent
restructured, rather than, there's a structure by which you can control the subsidiaries. So suppose you own 50% of one subsidiary, that subsidiary owns 50% of step-down subsidiary, and there's another 50%. So effectively, your economic ownership may be 12.5%, but you still control 51% from the top.
Yeah.
I thought that model is not really, good from the shareholders' point of view. Because if your economic interest is 12.5, then you should own 12.5 and let there be shareholders' democracy. They decide whether they want you to manage or somebody else. So we demerged the companies in the manner that all the shareholders get the shares in the same proportion. And me and Venkat, we are promoters. We don't have control on any of the companies. We are minority shareholders. And in a way, we are happy with that because we are there till all the shareholders, majority shareholders, basically want us to be there.
No, that's a brilliant thing to do
Yeah.
in shareholder interest. So most of the companies must have come up with a lot of help from VCs and private equities. So is there any story there that you'd like to tell us?
So we started getting private equity money way back because the first generation entrepreneur and I didn't have much capital to start the business. So we had many private equity investors over last 30 years. And actually that adds a lot to the governance, compliance, the risk management, and the best practices that you learn from them. Sometimes their processes, their monitoring can be very tedious, but I think on balance that has helped. We learned a lot from them. And fortunately, almost all of them have got very good returns. They, right from beginning, who invested in, when we were the first investment in 98, 99, to now, most of the investors have multiplied their money many times, whenever they exited. And then there are investors who have continued for a very long time.
Okay, so that's great. They've had a great experience, so they continue to invest.
Yep, thank you.
So are there plans to grow further? in different directions, or
I think we'll remain focused on financial services, will consolidate because the businesses that we are in have tremendous growth potential and a trajectory for growth. So there's no reason for me in particular or our core people to look at diversification as such. We are well diversified financial within financial services. I think we can consolidate, and these businesses are growing very well. So if you grow at around 25% compound, is fantastic over a period of time.
so what is the impact of the war that we recently had between Iran, Israel, and the US? What is the impact on your business?
So fortunately, India has been very well cushioned. So our business has not yet been much impacted because if you see, India's inflation has remained under control because government has not taken any major large-scale price increases in petrol and diesel, which has cushioned inflation. The inflation has not gone out of control. Supply disruptions have been very minimal. It is not like some countries where we see that there's no petrol and people are not able to drive cars to, or I mean, there have been stray incidences of gas, LPG not there in some of the restaurants, or sulfur dioxide not availability affecting some factories, but very, very minimal or minuscule percentage of businesses have been impacted.
They never reached a crisis
Never reached a
situation.
crisis. Even inflation has been well under control. RBI has done also fantastic job by managing liquidity in a smarter way, so that things have looked. So people, if you really look at small businesses, relatively what they were doing, I think all of them are in fairly good shape.
Okay, great. So one last question, basically from the point of view of a retail investor, the small guy. So markets basically go from euphoria to pessimism. Then occasionally what happens is that everybody is in euphoria and occasionally everybody is pessimistic. So what is your advice to a regular retail investor?
It's a good question. So regular retail investor will be earning consistently and saving consistently, right? Like a typical salaried person will get money every month, once a month. So the best advice, although it's boring, is not exciting, is that you do a systematic investment or systematic savings. So just like we had a piggy bank when we were a child. So every month you save and you invest. Don't worry about the market. You cannot time the market. What matters is the time that you are invested in the market. The
Time-
longer
Instead of timing the market, you should be
the
focusing
time in
on
the market.
time in the market.
The longer the time, the more compounding will happen.
That's a quotable quote.
So people who started saving and invested for 30 years vis-a-vis somebody for 20 years, there's a huge difference in the money that they will compound. So there are people in young age, they say, I'm going to spend, and for 10 years they don't save. They start later. Then by the time they retire, their wealth is significantly lower than.
Okay.
So I think time in the market or the time that you invested is more important than trying to time the market. So retail investors should not worry about what is happening. India's economic fundamentals are very good over long term. It's like India, in a little this thing somebody put it very nicely, that is an ugly picture but a beautiful movie. So what does that mean? Is that at any point in time you take a snapshot. Oh my God, there's so many problems. This is wrong. This is wrong. But you say 5 years, 10 years, 15 years is compounding. Things are getting better. You look back after 5 years, so many airports have become better, so many roads have become better, and our all income have become so much better, wealthier, and and every time we keep complaining.
You were always
So-
a good one-liner person.
Yeah.
So on that note, thank you
Thank you so much.
Very kind of you to
Thank
be
you.
on this podcast. Thanks a lot.
Thank you. Appreciate it. Thanks.